Hi and welcome to Swissquote Daily Market Talk. It's Friday, August 29th. The disappointment following Nvidia's quarterly results remained quite short-lived. Risk appetite returned, sending US equities back to fresh all-time high levels as US GDP update printed stronger than expected growth with steady price pressures for the second quarter. So could today's PC read change that narrative? We will talk about all that and more, but before we do, please keep in mind that opinions are my own and this is not financial advice. So investors on Thursday rapidly shrugged off the initial disappointment of Nvidia's quarterly earnings report that hinted at slower growth rate for AI demand. The company still grew 56% compared to the same time a year earlier, but its data center revenue was very slightly down. And that didn't really please because many connected the dots, pointing that Meta also has recently froze its AI spending, and other big companies that are the clients of Nvidia could also take a similar path, as investments don't necessarily bring the return that they ideally should on these AI investments. But the fact that Nvidia's numbers and the company's forecast fully filtered the Chinese business out somehow gave hope to investors in that these numbers, so the forecast and the quarterly numbers, could only improve if the company could sell its products to China, because every chip then would be a tailwind. Better yet, 10 firms increased their 12-month price target for Nvidia following Wednesday's earnings report. The average price target was raised by 3% to $202.60 per share. As such, the after-hours dip that we saw in Nvidia's shares has served for some investors as an opportunity to buy the dip. The share price swung up and down yesterday, tested its all-time high level, and closed the session just 0.79% down. We conclude that Nvidia's latest report didn't trigger a significant negative reaction and that the fairy tale continues. Now, broadly speaking, the S&P 500 companies printed a much better than expected performance in the second quarter of this year, almost 12% earnings growth versus just 4 to 5% expected by analysts into the earnings season. And plus, the Fed expectations have softened dramatically since the beginning of August. As such, the sky now looks clear for further gains for the S&P 500 companies. The index indeed hit a fresh record high again yesterday. It was the 20th record high since the end of June, taking intraday highs into the account. And all that regardless of the mounting worries of weakening jobs market in the US. What amazes me is that the jobs market is pretty much the only major area that worries investors, and not really because it boosts the Fed cut expectations, because yesterday's second quarter GDP update from the US exceeded market expectations with a 3.3% rebound in growth. Sales jumped 6.8%, while price pressures returned to around 2%. I mean, the data could hardly be better, because earnings have been robust for the big companies. The small companies that were pressured by tariffs will benefit from Fed rate cuts, as inflation metrics don't show the tariff-led pressures just yet, and also because Donald Trump is fighting to get his rate cuts from the Fed. And today, the Fed's favorite gauge of inflation, which is the core PCE index, is expected to print a minor quickening to 2.9% year-on-year in July. The figure remains sticky above the Fed's 2% policy target, and risks are rather tilted toward the upside, but with attention now shifting toward the weakening US jobs data, anything less than a major surprise to the upside for inflation should not derail the expectation that the Fed will cut its interest rates in September and one more time before this year ends. And the latter is obviously positive for equity valuations. Now, for the FX, the US dollar has been under a decent selling pressure of trade tensions in the first half of this year, and the dollar is now under the pressure of the rising dovish Fed expectations. But if inflation in the US remains in check while economic data shows strength, well, it should somehow rebound against majors. Stronger dollar could then weigh on equity valuations because it would make the company's outside foreign sales look less in terms of US dollars, but the soft Fed outlook will likely outweigh. It's great, no? But here's the catch. there is no guarantee whatsoever that inflation in the US will remain in check, because consumers in the US should expect a shock when ordering goods from other countries starting from today, reminds Bloomberg News. Why? Because the US will end the so-called de minimis exemption that allowed parcels worth less than $800 to avoid tariffs and enter the country tariff-free. Now, these little packages will be taxed, and the number of packages claiming the exemption was nearly 1.4 billion in the US government's 2024 fiscal year, and that's roughly 3.7 million packages per day. And that helped fuel the growth of e-commerce business such as Amazon.com and Shein and Temu in recent years. And Temu already saw its demand cut nearly by half since a couple of months. So the rest will probably follow. And with the expected surge in low-value goods prices in the US, August consumer inflation could eventually face additional upside pressure, just as the Fed will be lowering its interest rates. And higher inflation could eventually complicate the Fed's easing path. But for now, the cautiously positive outlook for equities reigns, but there are risks that are piling up still. And speaking of inflation, major euro area economies will be revealing their August preliminary inflation figures starting from today, and these figures are expected to show some upside pressure in the euro area economies as well. Rising inflationary pressures will likely cement the expectation of a pause to ECB's rate cuts at the September meeting, along with more clarity on the tariffs and the possibility that there could be a deal for the European car makers too in the coming days, bringing their tariff cost to 15% when exporting to the US from 27.5% today, and provide further relief to the European economic tissue. But any hawkish shift in expectations could see a limited upside potential from the Euro bulls, mind you, that are focused on the French political shenanigans and the widening yield gap between the French and German Bund yields, on high probability of a new government collapse in France just within the next 10 days. So the euro dollar hovers around this 50-day moving average this Friday, with thick offers seen into the 118 psychological mark. Elsewhere, the dollar yen is testing its 50-day moving average to the upside again today after the economic data there showed slower inflation in Japan alongside weaker than expected sales and production data. So the pair's downside potential remains very much uncertain, as slower inflation could give the Bank of Japan more time before hiking its interest rates. In the energy space, US crude tested but couldn't clear the critical $65 per barrel offers this week. The 2.3 million barrel fall in weekly US inventories last week and the lack of progress in Ukrainian peace talks actually keep the downside limited, while the chances of a geopolitically supported spike are rising. So if that's the case, we could eventually see a spike into the 200-day moving average that currently stands just a touch below the $68 per barrel level, but further upside looks unlikely at this point in time. So yesterday's strong GDP figures from the US helped lift the SPDR's energy fund yesterday to its highest level since April, while rising inflationary pressures could, going forward, draw more capital into these dividend-paying companies in the energy space. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.